On this episode, we're going to talk about a unique way of investing your money in a real estate IRA. Hello everyone, welcome to the fourth episode of The Bob Wall Show. On The Bob Wall Show, we talk St. Louis, we talk real estate, and we talk business. On today's episode, I have Patrick Hagen with the Entrust Group, and we're going to talk about self-directed real estate IRA. Patrick, thank you so much for joining us. This is a little bit of a more complex topic to cover, so I really appreciate you coming on to help educate everyone. To start off with, I'll let you tell everyone a little bit about yourself and a little bit about the Entrust Group.
Okay. Well, thank you for having me today. And it is a unique topic. It's something that a lot of people aren't familiar with, but it's something that's growing in popularity. And our firm's been doing it for 34 years, but still, relatively speaking, the average investor doesn't know they can buy property within their IRA or 401k. So we spend a lot of time educating, doing things like this, teaching classes. And really, in a nutshell, what it is we provide people an opportunity to invest their retirement money into real estate.
Okay.
Instead of just buying stocks, bonds, and mutual funds, you could take the same tax-deferred wealth, shift it over to the Entrust Group, and put it into property. It could be land, it could be condos, homes, whatever, fix and flips, whatever you decide you want to do within your retirement plan. We provide the necessary IRA administration for it, but the client determines what they want to do. And by virtue of us not telling them what to do, not being a fiduciary, we can hold anything the IRS allows, which includes real estate.
Okay.
I've personally been doing it now for about 11 years with the Entrust Group. I have an office here in St. Louis, as well as a couple other offices throughout the country, and spend most of my time answering the same questions we're going to talk about today.
Right.
This is good stuff.
And I'm going to ask you the same questions you get 30 times a day, which
Enjoy
means
it.
it'll be easy for you.
That's right.
So
I should be able to handle
it. So when most people think about our IRAs, they think about the traditional, the stocks, bonds, mutual funds, that sort of thing. But actually, you can do an IRA on just about anything.
Pretty much anything, yes.
Yeah.
And I'll kind of give you the backstory of why you think IRA and your mind immediately goes to stocks, bonds, and mutual funds.
Right.
The simple fact is the majority of companies that do retirement plans are brokerage firms. They make their money by selling securities. Yeah. So if you go to a brokerage firm with your retirement plan, they're going to sell you securities. Yeah. It's not that they, from an IRS perspective, can't hold real estate. It's more of an institutional thing. As an institution, they choose not to allow real estate because there's no incentive for them to sell real estate. They don't get paid on selling real estate.
Right.
They get paid on selling stocks.
Right.
So if you want to buy stocks, bonds, and mutual funds, then you don't need a self-directed IRA.
Right.
If you want to do something a little alternative, whether it's real estate or maybe an LLC or notes or something along those lines, that's when these niche companies called self-directed IRA providers become useful.
Okay.
And so basically, anything that's an investment that you're holding as an investment that's not life insurance and not a collectible item can be wrapped into a retirement plan.
Okay.
So we mentioned earlier that buying real estate is unique, but it's not new. It's been around for 40 years. I mean, IRAs came on the scene in 1975. And frankly, since 1975, if you wanted to buy property within an IRA, you could do that.
Okay.
The issue you would have found back in 1975 is there was no custodians holding those types of assets.
Okay.
Now, our firm started in 1981. There's now probably 30, 35 companies nationwide that do self-directed IRAs. So if you want to buy something like property, that is an option.
Okay.
Relatively speaking, we're quite a bit smaller than the large banks and brokerage firms.
Right.
You're not going to see us during the seventh inning of the Cardinal game or tonight during the Blues game or anything like that. We don't have that kind of marketing budget.
Right.
We grow organically. We're kind of a smaller organization that grows by word of mouth. But people are telling people, and as they continue to tell people, our business and our industry is really starting to take off, which is exciting.
No, that is exciting. And I actually bump into you. I see, really, I can honestly say, I can vouch for what you just said. I see you just about at every sort of, real estate related function group. I see you out there. You taught a class at the St. Louis Association of Realtors. That's how I initially got introduced to this whole topic. And at the time, this conversation will probably bore at least 50% of the people out there, as informative as it is. This video particularly is definitely more about education than entertainment. But when I signed up for that class, it was one of the coolest things for me to take, because I had no idea that was out there. And when I saw the name of the class, I was sold on it, and I was impressed with how you handled a group of, I don't know how many, there must have been at least 300 plus, 300 plus realtors there, and to control a group of realtors on a complex topic like that, I was impressed. So,
well, thank you. I enjoy teaching.
Now, as far as, I guess I want to get clarity too, as far as what your company does. So do you, are you a financial company that manages people's IRAs, or do you manage just the self-directed IRA itself as far as the day-to-day maintenance of it?
Right.
Does that make sense?
Yeah, no. So the best way that I can explain it is we're an IRA administration company.
Okay.
So we hold IRAs in the same sense that anybody holds IRAs.
Okay.
The difference is everything is truly self-directed, which makes us way more of a facilitator than it is a wealth manager.
That's where I was going.
We're not a fiduciary. So if you moved over $200,000 to a self-directed IRA and didn't give us instruction, it would just sit.
Okay.
Right? We are an order taker. I tell people all the time, like, I'm a glorified order taker that does whatever you tell us to do when you tell us to do it.
Okay.
Now, we do monitor activity. We try to educate. We make sure that people understand the rules to the best of our ability to make sure that they comply with those rules.
Right.
But at the end of the day, our job is, if you say, do this with my IRA, we do that, right?
Right.
And it's worked out to be a very, it's very much of a need-based transactional business.
Okay.
Nobody opens an account just to open an account. They open an account because they want to move over money to specifically buy something that they can't do with their current broker.
Okay.
So a client will call me up and say, I want to buy a property, looking at closing in about 6 weeks. My money's over here at ABC Wealth Management Group.
Okay.
I want to move it over to Entrust to specifically buy that property.
Okay.
So our job is to get their account open, pull in the money, and then facilitate that actual real estate purchase at their request.
Okay, so the people that, the market, the target market for the people that would be one of your best clients, or the people that would be most likely one of your clients, are people who are already educated on what they plan on investing in.
Right.
So you're not promising X amount of return on whatever investment. You're simply taking someone's investment money and setting up the account so they can do their own self-directed IRA on whatever they feel is a good investment for them.
That's exactly right.
Okay.
Yes. And the difference is, frankly, the term fiduciary is a very important term in our industry.
Okay.
We are not a fiduciary. A fiduciary is somebody that gives financial or investment or tax advice.
Right.
All the wealth management groups in St. Louis, they're all taking on a fiduciary role. And frankly, that's why they don't hold real estate. Because you can't say that all of this is wealth management by our firm and this is self-directed where we don't have any control. It has to be very clear, kind of a line in the sand, that all we do is self-directed retirement plans. We don't do anything without the client telling us to do it.
Okay.
And that relationship of us not telling people what to do and instead just taking orders opens the door to anything the IRS allows, which includes real estate.
Okay.
So the essence of what we do is that I'm not promising returns. I'm not telling people what to do. I'm not even giving financial investment advice.
Right.
I'm more holding the account as an IRA administration company and then facilitating purchases at the client's request.
Okay.
And that arrangement opens the door to real estate secured notes, LLCs, private placements, private notes, precious metals, all kinds of different things.
Okay. So to give like a real life situation on how this would work, there was, unfortunately, I missed it in time, but there was a really good investment opportunity at a house near me, $40,000 for the area it was in. I'm sure it needed a little bit of work, but it would have been a great investment opportunity. Let's say that I see a property like that and I have X amount of dollars sitting in an IRA somewhere, and it's getting X amount of return, but wow, I know that this would give me a really good return.
Right.
How does the process start as far as, let's say I put a contract on it and I get the seller to agree to the purchase with the contingency of transferring the money from an IRA to rolling it over into a self-directed IRA like this.
Right.
That seems to be, does that seem to be how it kind of works?
That's exactly
in a real
how it
estate
works.
transaction?
Yeah, that's a good fit. So you're
okay.
describing a good potential Entrust client.
Okay.
Somebody that has some retirement plan wealth, has a desire and maybe an interest and some knowledge of buying real estate, and wants to move the wealth from over here to a self-directed IRA specifically to buy a property. So say, hypothetically, it's a $40,000 investment. You think it's going to take maybe 10 or 15 to fix it up. So you move over, maybe $65,000 from company A over to, in this case, company B, which is Entrust. We set up an account. The contract actually goes in the name of your IRA. So it'll be in the name of the Entrust Group for the benefit of your name, IRA. Your IRA, your individual retirement account, is buying that property. Our job is to facilitate that on behalf of the IRA. So when you set up that account with us, we have dialogue about what you're going to do. I pretty much already know what's going to transpire. You tell me, look, I found a property, it's going to cost 40, I'm going to put in 15, I'm going to move over 60, 65, whatever the case may be. So our job is to get the account established, go pull the money from the current custodian over to us, and then get involved the title company to actually facilitate that closing. So you are directing everything. You're pulling the strings. We are basically doing what you tell us to do as the IRA provider that's facilitating on your behalf.
As far as, we go through the process and it's set up. The property is under, the property's now under the IRA and under your management. What am I allowed to do from here? I know there may be some restrictions as far as being the property owner, but it's actually, I guess that's the key, is I'm not the property owner. The IRA is the property owner. So what are the rules as far as what I'm allowed to do, because it's actually under the self-directed real estate IRA?
So quick background before we get to what you're allowed to do. The IRS basically the government created IRAs in 1974. They came on the scene in 1975. In publication 590, they indicated what you can and cannot do within a retirement plan. Specifically, the rules are in a section code called IRC 4975, and it says that you can't buy collectibles and life insurance like we talked about. It also states some stuff about utilizing investments that are owned by your retirement plan for personal benefit, and then has information about doing physical work or services to an IRA-owned asset. So, long-winded answer to your question, you can't live in the property, and neither can your kids, your parents, your spouse. Those people are called disqualified persons. So they can't live in the property, they can't stay in the property. If the property was down the block from SLU and your daughter went to SLU, she can't live in the home, right? That's rule number one. Rule number two is, and it gets a little more gray on rule number two, is technically you can't physically work on that property because the code states that you should not provide, quote, goods, services, or facilities between yourself and your retirement plan. So the best way to describe it, in my opinion, is you can point at the wall and tell the painter to paint the wall blue. But don't pick up the brush and paint the wall blue, because as soon as you start painting the wall or knocking down the fence or landscaping the backyard, you're essentially providing a service. You're physically putting in sweat equity, and that's problematic. But if you're dictating what happens, that's no different than me sitting at my desk and clicking a mouse to buy or sell a stock, right? Using your brain, using brain equity is fine. It's the sweat equity you want to refrain from doing.
What about like the screening of potential?
That's fine, because again, that's kind of brain equity, right? You're deciding this person is going to be a good tenant.
So you can do the screening of the
no, I don't think there's any
tenants
problem with deciding. It's kind of like, so you threw out $40,000. Do you pay 40 or do you pay 45? Is it worth 50? And do you negotiate? You can still think your way through this. The IRS isn't saying because it's an IRA you can't be involved. What they're saying is they don't want you to physically go in and gut the place, put in new carpet, new floors, new roof. Just don't do the physical labor. That's really where you need to draw the line. But as far as you deciding what to do and overseeing the investment, the term that gets tossed around a lot is management. I generally try to correct clients and say you don't really want to manage the property, but it's perfectly fine to oversee the activity of the property. You are still the decision maker. And frankly, if you don't make the decision, no one's going to make the decision, right? We can't make the decision for you. And if you don't have a wealth manager making the decision, someone's on the hook to make the decision. So by nature, you have to decide what to do. You just want to make sure that you're not physically out there knocking down walls and painting things and doing things of that nature. So refrain from physical labor, but actually making decisions is fine. And
it sounds like this is more an IRS issue than anything.
It really is. And everything that we do.
Because there's tax advantages to the IRA, which is what makes it a attractive investment for a lot of people. So the IRS is making sure that it stays it serves the purpose that they're intending, I guess.
Well said. Yeah, absolutely. So IRAs have special tax treatment. You're in a tax-deferred bubble. In a Roth IRA, it's a tax-free bubble if you qualify. And so in order to maintain that, there are certain things you cannot do, like live in the property, work on the property, things like that. But no, to your point, an IRA is an IRA. And the tax-deferred benefits of an IRA with Entrust are the same as they would be with any bank or brokerage company. The only distinction is the asset that you're holding. You're holding property instead of holding stocks, or you're holding a note instead of holding mutual funds. But the essence of the IRA is the same. A traditional IRA is a traditional IRA. A Roth IRA is a Roth IRA.
Okay.
And you also mentioned that, you know, the rules that we claim are like our rules. They're really not our rules. We just package the IRS rules and put them on our website and say these are the things you can and cannot do. We don't really, as an institution, have any institutional rules that I can think of. I mean, there's nothing that Entrust says this is a good idea or a bad idea. If the IRS permits it, we do it. If the IRS says no, we don't.
Okay.
Now, there's a certain level of gray in there.
There's
and there is
gray.
a time that we will punt to the CPAs and say, you know, what you're deciding here or what you're making a decision on is somewhere between that right and that wrong. And because we're not a fiduciary and we're not a tax advisor, we can't give you tax or legal advice. So go talk to the tax advisor, go talk to the legal attorneys, whatever. But generally speaking, most of what comes up on a day-to-day basis, we can answer definitively because it's standard IRS rules. Right? Either you can do it or you can't. It's pretty rare that somebody comes on board and asks a question that is really in the gray area between, you know, what's definitively right and definitively wrong. And frankly, then you look at like individual court cases and rulings, and they've clarified things over the last 40 years. You know, sometimes people have stretched the boundaries a little bit, and they go through a court proceeding, and the court says, no, you pushed it too far, or yes, that's okay. So every time they make a ruling, we track that stuff, and then we come back and say, okay, well, based on such and such, it appears that this is okay. We can't tell you definitively yes or no, but it seems to be okay per blah, blah, blah. So that's the type of stuff that we've been able to do. Our history of 34 years in the industry have allowed us to kind of adapt and evolve a little bit with things that we know have changed a little bit since the code drafted in 1975. So it's you can leverage to some degree, if nothing else, just our experience. The stuff that my administrative assistant can answer on the phone, most CPAs can't answer on the phone, and she's my admin, you know, but she's been exposed to it. She's gone through enough of these situations.
She hears a lot of the same questions.
Yeah, I tell people all the time, it's like I've studied this unique topic for 12 years, and if that's all you do all day, every day, you pick up on some stuff. You know? I can't tell you about physics or anything complex like that, but I can tell you about self-directed IRAs because this is all we do. So it's second nature to us.
Yeah, that's great. As far as IRAs go, is there any sort of difference or anything worth knowing as far as a Roth IRA with this sort of thing, or an IRA? Is a Roth allowed?
A Roth is allowed, yes. Any type of IRA can be self-directed. So for the benefit of the viewers that maybe don't know the difference between a traditional and a Roth. Traditional IRA is a pre-tax, tax-deferred vehicle. So you're making investments that grow tax-deferred over your lifespan, and then at some point down the road when you pull it out, at that point it becomes taxable. With a Roth IRA, it's kind of the opposite of that. With a Roth, to use an analogy, you pay tax on the seed but not on the crop, So you pay it right now. If I put $5,000 in Roth, I pay tax now.
That's a good analogy.
But if you grow that Roth over time, assuming you're 59 and a half, assuming you've had it for at least 5 years, the money can come out tax-free. So literally, it's one of the few opportunities to buy and hold real estate in a completely tax-free environment.
So let's say that we start contributing to a Roth IRA and it aggregates over 10 years, and we see an investment property for $100,000, we have $150,000 in a Roth IRA. We can transfer that over, and it's still tax-free because it's set up under the Roth. So, and it works the same way under the IRA as well. Each IRA, it just transfers over with the same set of rules, restrictions, whatever, terms and conditions as the way it's been set up.
Absolutely.
From day one.
Easiest way to explain it is, at its core, an IRA is an IRA. Self-directed is a descriptive term. And frankly, it's a term that us, along with the other key players in the industry, kind of created to define the types of IRAs that we hold. Because we need to distinguish, how are we different than the wealth managers and brokerage firms? Well, everything is self-directed. So that just means that you control it. But at its core, the accounts that we provide administration for are traditional IRAs and Roth IRAs and SEP IRAs. There are no distinctions at the core. The only difference is the institution. The reason why Edward Jones doesn't want to hold real estate is because as an institution, they have chose not to be involved in real estate. It doesn't fit their model. It doesn't work for them.
Right.
I tell people all the time, to use an analogy again, if I had a toothache, I wouldn't go to an eye doctor. I'd go to a dentist, right? They both have doctor in front of their name, but one specializes in one particular arena.
Right.
What we specialize in is everything that those firms don't do.
Okay.
And that ends up being real estate secured notes, private placements like LLCs and private equity deals, and a little bit of space of like precious metals, gold and silver, things like that.
Do you guys ever do any business with any wealth management that maybe do have clients that invest in real estate IRAs?
We do. Yeah, we try to be. We don't. I mean, I'll just be fairly blunt. Yeah. We don't have a lot of people that actively promote what we do.
Right.
Because at the end of the day, the money has to go from them to us to buy that rental property, right? So if I'm a wealth manager making 1% of assets, I'm not going to actively tell my clients, look, here's an opportunity to move your money away, right?
Right.
So, but on the flip side, we are very active in the community. We teach classes, we give presentations. In the event that their client says, hey, I found this $40,000 property, it's a steal, it's probably worth 80. If I put in 20, it's worth 125, whatever. They want to have a resource, and we're like a resource, right? We are a company they refer business to when they can't do what they're trying to do for their clients.
Right.
So it ends up being more of a, not like I'm going to actively go out and promote Patrick at Entrust.
Right.
I'm going to call Patrick when my client
something
says,
has to get
I'm
done
ready to do it. Because a good wealth manager, and I'm going to throw my bias here, but a good wealth manager is going to manage the account to the best interest of the particular client.
Of course.
And if the client is somebody that has the desire to buy investment real estate as a portion of their retirement holdings, then the wealth manager should assist in helping them do that.
Right.
Now, a key point there is they don't have to move their entire portfolio. You know, if you have 300,000 over here and the property is 120, well, then move over 120 and leave the rest where it is. You could do both at the same time and have some greater degree of diversification. You got your wealth spread into different investments with different companies. It can be a nice complement to somebody's more stock-heavy portfolio.
And I agree. I'm not promoting that everyone needs to invest in real estate IRAs. Being in real estate, I'd say at least half of my retirement is going to be coming from real estate investments. At least that's the goal, and that's how I like to see things transpiring. But there's plenty of room for the traditional IRAs and investing in stocks, and there's something to be said for diversifying and investing in with stocks. It's a little bit simpler. You don't have to think about it, and you get a good investment.
Get a good wealth manager, you can turn it off a little bit and release that control and let somebody manage it. And to your point, there self-directed is self-directed, meaning you have to decide what you want to do.
You have to know what you're doing, and you need time to do it. And
it's not a fit for everybody. I mean, I've talked to people that say, I've got all my money with the wealth manager. I'm happy with the stock market. He's diversifying my funds, whatever the case may be. And we say, great. There's no need. I'm not trying to sell those people.
Right.
And you brought up something earlier. You said you're not trying to convince people to buy real estate with an IRA.
Right.
Neither am I.
No.
All I'm trying to do is make them aware of the fact that if they have a desire to buy real estate and they have a retirement plan, that we can facilitate that type of transaction. So I'm not looking to tell people what to do with their retirement money. I just want to bring awareness to their options, because right now, unfortunately, there's some $7 trillion in IRAs currently. Less than 3% of it's in real estate. So, our industry has really focused on, maybe taking that 3 up to 6, maybe get it up to 10, something like that.
Right.
I mean, we're not looking to get everybody to move over their retirement funds, because not everybody wants to buy property. But I've been struck by how many times I talk to people on the phone and they tell me, look, I've been investing for years. I've been buying real estate for years.
Right.
I've been looking for this for years, and no one ever told me it was an option, right?
And
some of my best
the
clients,
whole thing. That's the whole thing. Is this is about making people aware that the options available, because you're not going to hurt yourself by having the information.
Exactly.
That's for sure. Knowing that that's an option, and you never know when you're going to run across that $40,000, $100,000, $200,000 property. However expensive the property, and it's good to know that this is at least an option. It may not be something you pursue, but it's good to have in your back pocket.
Yes.
In the event that you run across something like that. So,
not to mention just simple diversification. I mean,
I
every
agree.
wealth manager talks about you need to diversify your holdings. And most people with a fair amount of wealth, they diversify their personal holdings. They own real estate, they own stocks, they own CDs, they own other stuff. And then you look at the retirement plan and it's all in the stock market. And you're like, what's the missing piece here? Well, the missing piece is the people that are controlling your retirement plan are only allowing a certain type of asset class. And so,
Right.
roll the clock back to 08, 09, it doesn't really matter how spread out you were in the stock market. The stock market went down over 50%.
Right.
So it doesn't matter how diversified you were, you probably took a hit if all of your money was in the stock market.
Right.
So that may be a bad analogy because real estate went down at that time as well. But I tell you, I have a whole lot of people that moved over money in 08, 09, 2010 that bought some of these properties that are now selling back for what they're worth, but they bought it for 40, 50 cents on the dollar. So by getting your money into different alternative investments, you're spreading out your wealth into different pockets, you're doing something different. And like I said, my average client, they love real estate, right? I'm not trying to convince people the benefits of real estate. They know that far better than I do.
Right.
They just want to find someone to work with to unlock that IRA so that they can do real estate alongside their stocks and mutual funds.
And if in the differences, there's a key difference. One of the benefits of real estate IRA, yes, people with real estate investments, that went down too in 2008, no doubt about it. But the difference is if you're investing in rental properties, that sort of thing, you're not losing your return on investment because you're collecting rents.
Right.
And just because the property value's down, the amount of money you're making from the property is still the same. Whereas opposed to stocks, that goes down. The interest from the stocks is going to
Exactly.
You are going to take a hit on that.
And
so.
to a slight degree, and again, we don't want to get
Not
involved in
saying-
telling people what to do,
Right,
but
right.
there is a little bit more control. Now, granted, things go wrong with real estate.
Yeah,
I'm sure you've got
a lot
horror
more. It
stories
might
to
be
tell
a
you.
false sense of security, but
Sure.
no.
But if nothing else,
there's
you
more
can,
control for sure.
to the best of your ability, look at a property and based on the market, determine how much it should bring in rent, right?
Right.
Look at the property and determine to the best of your ability how much it should cost you in expenses.
Right.
And barring something unforeseen, you can do simple math and figure out, okay, if it does this, then I should generate this kind of return, right?
Right.
With the stock market, you generally, now obviously people that analyze stocks have a much better ability to do that than the layperson would, but there's a lot that goes on. Greece could default on their debt and you didn't do anything wrong,
Right.
but globally there's a mess, right? And so
Right.
those situations come up, not to say that real estate in any way immune from that, but it is a little bit different because you're looking at the asset and saying, based on the factors involved, I'm deciding that this is what I'm going to hold. And I think a lot of my clients also like the fact that it's a tangible asset. If you want to walk over there and kick the side of the house, there's something there,
Right.
What's behind your mutual fund? Well, your mutual funds invest in this and diversify into that, but really what is there, right?
Right.
And there's something there, but I think to actually quantify that and see it, a lot of people like that. I'm looking at this house, which is down the street. I can see it. I can talk to my tenant. I can pick up a rent check if I want to pick up a rent check. So it's just a little bit more control. And our clients tend to really like control.
Okay. As far as who has title to the company, I assume it's safe to assume that the IRA holds
The
the
IRA
title.
is the legal owner, yes.
Okay.
So,
Okay.
if it's John Doe investor and he has an account with the Entrust Group, the actual deed would read the Entrust Group for the benefit of John Doe IRA.
Okay.
His IRA would be the legal owner.
Okay.
Now, one asterisk to that is sometimes we see people structure their holdings through an LLC. They'll take their IRA, put it into an LLC, and then have the LLC make the investment.
Okay.
It's just a different way to structure an investment. So that's another way that we see people do it. But
Okay.
most of our clients are buying property, they deed it directly to their individual retirement account. The IRA is the owner.
Okay.
We don't own it. The client doesn't technically own it. The client's individual retirement account, which is controlled by the client, is the legal owner.
Okay. Okay. Let's see. One of the last questions, and really this is one thing I was really looking forward to talking to you about, and it might be a short and sweet answer, but when I took your class before, you mentioned you're looking in to potential loan programs that people offer for an IRA, meaning I assume that it would be good. It would be awesome if there is a loan program, some sort of lender out there that would lend you money to where the IRA is holding the loan.
Yes.
And you could invest in property that way.
Yes.
Have you run across anything like that?
Yes, there are
Okay.
lenders. The term is non-recourse. Okay?
Non-recourse
so
loan.
The
Okay.
difference is with a normal loan through a normal bank, someone signs on the dotted line. They promise to repay the debt, right? That's why they pull your credit report and they look at your personal financial statement. They want to see, okay, if this thing doesn't work out on paper, who am I going to fall back on, right? That's called a
Right.
guarantee. It's standard with almost every loan that banks do. With a non-recourse loan, the loan is made to the IRA, not to the individual.
Okay.
And the IRA is responsible for paying the debt. The reason it has to be non-recourse is because the code states that as an individual, you cannot extend credit on behalf of your IRA. So if my IRA is going to go to the bank and borrow money, I can't guarantee the debt. So the bank's not looking at me or my credit score or my personal financial statement. They're just looking at the asset by itself, securing it by the asset itself.
Okay.
And actually these loans have a very low default rate, but a lot of banks just don't want to fool with it because standard banking is, you look at the deal. If the deal's strong, you look at the individual. If they're strong, you lend the money.
Right.
In this case, you're not even looking at the individual. So I've been looking, and I'm still looking, if anyone's out there that works for a bank, for a local lender here in the St. Louis market that's willing to look at doing non-recourse loans. I think I could probably refer them a fair amount of clients. I know of a bank out of Kansas City that does non-recourse loans. There's one out of Colorado and one out of
Do they loan in
South
St. Louis
Dakota.
or do they loan in their markets?
Oh, they lend all over the country.
Do they
yes,
do?
Yes.
Okay.
And if anybody wants a list of who those lenders are, I could send that out via email. I've got a list of who they are and the contacts at the bank.
Okay.
Typically what they look for is a slightly higher down payment, somewhere in a range of 30 to 35%.
Okay, that's still
It's reasonable.
yeah,
right.
No, that's still good.
Yeah,
That's
it's
still
not
good.
bad. Well, it's funny because
So,
back in
yeah.
2004, it didn't
Because
sound
the
very
idea is
reasonable.
to make
but-
money off of someone else's money.
Right.
So if you can put 30, even up to 40% down, but finance the rest and put in an IRA, I mean, that you're getting, I don't have the calculations to line out in front of you on how that works out, but I mean, that's a pretty attractive investment.
It expands your buying power.
Yeah,
Right? Somebody
yeah.
that has $100,000, if you're looking at buying stock, you can buy $100,000 worth of stock. If you're looking at real estate with debt, you might be able to buy something for $225, something like that. So it does allow you to buy potentially larger assets, which might appreciate faster, which might have better rents, whatever the case may be. A lot of my clients buy their property for cash just due to simple simplicity.
Yep, right.
You know,
I
I've got,
understand
like your
that.
example of the $40,000
I
house.
understand.
Like I've got 40 grand, I'm going to buy it with cash. There's no bank, it's easy.
Right.
But for the people that go out, they find a non-recourse lender, they get someone to approve it, they can do it. We do have a fair, I don't know the percentage off the top of my head, but we have some clients that finance. And it does expand your buying power. You can buy something worth more than what you have in the IRA, or maybe you have $100,000, you want to buy two properties, right? So you put up 50 on each and borrow the difference.
Right.
So it is out there. I've had some dialogue with a few local banks. I've actually had a few kind of bite a little bit.
Okay.
Nothing that's materialized to the point to where I could say, here's a bank locally that does non-recourse loans.
Right.
Fortunately, the largest non-recourse lender in the country is in Kansas City, which is only 4
Not far,
hours down the
yeah.
road. So
Right.
it's not like you're talking to somebody in California or Maine or something like that. They're about as local
Same
as you can
state,
get without
at
being in
least.
St. Louis.
Right.
Yeah, right.
Right.
Different baseball team, but same
Right.
state. So
Well, that seems like a really attractive option as far as cash is much simpler. It requires far less due diligence. We're taking something a little bit more complex and unique and definitely adding another layer to it when you start talking about the loan part of it. But for me personally, it sounds like worth digging a little deeper on doing a little bit more due diligence, because return on investment and what you're able to do with your money, it seems like that could be a pretty attractive option.
it's definitely out
So,
there. And like
yeah,
everything we do,
right.
we're just trying to, we're just getting as much information as possible.
Yes.
You know, when I teach those classes, I always go in there and think, I hope it totally overwhelm people. Like,
Right.
I want to get as
And
much
you are,
information.
you're good right now. We're overwhelming
Probably going to overwhelm some people.
a few people,
Yeah.
and that's understandable because I was pretty overwhelmed. And it was a 3-hour class. We're doing maybe a 20-30 minute video here, but the idea is introduce it to people. You don't need to fully understand it really the first time around. It's just we're introducing it to you. It's going to overwhelm a few people, I'm sure, but it's really good. What we've done to at least a few people, I guarantee you, is we got the wheels turning.
And that's
a
all.
little
That's
bit.
all we
So,
try to do is just try to
right.
get the wheels turning, get
Right.
the conversation started. And you know, for what it's worth, our company has been doing it for 34 years. I've been doing it for over a decade. I can't help by answering questions. So as those
Right.
wheels start to turn, you know, I think I told you at the class, like you're probably going to go home and there's going to be a question, or there's going to be a like,
Yes.
what about this scenario? That's the stuff that we do. You know, I
Right,
get to the
right.
office at 8:30. I
Right.
put on a little headset and I talk to people all day long.
Right.
And so I actually enjoy doing it. It's like for some reason I
Right.
enjoy that part of the job.
Right.
So I tell
Right.
people all the time, you don't have to be an expert in this, but consider it as an option. It may not be a good fit for everybody, but if
Right.
it's something you're interested in exploring, let's talk about it and grab a cup of coffee and come to our office in Chesterfield, whatever the case, whatever works best. And we're here to be a resource. I mean, we decided about 3 or 4 years ago that our company, our business development / marketing / whatever you want to call it, was going to be 100% education and learning based, right? We are going to educate the public on how this works and trust that hopefully as more people become more aware, that some of that's going to trickle back to the people that educated in the first place, right? Maybe we're foolish, maybe we're educating for our competitors, I don't know. But I don't know any other way to sell what we do other than making people aware of what we do and then answering straight questions with straight answers. And that's really what we do all day long. And it's a unique product, it's a unique industry, but I can tell you this, the industry has grown substantially in the last decade for sure, but really in the last 4 or 5 years.
After
really
what happened in 2008, I could see it being growing in attraction for people about having control.
Absolutely. That's what 2008 and 2009 did, was it brought awareness to the fact that just tucking your money over here and forgetting about it for 30 years is not enough. You have to take an active approach. You maybe got to look at some different alternative investment options. And again, my clients, most of them just really like real estate. So what we're saying is here's an opportunity to, with your tax deferred money, or in some case tax-free money, go out and buy and hold investment real estate, which you already enjoy doing, but have it in that tax deferred bubble, have it inside of the IRA. And that's really where Entrust fits into the equation.
Awesome. Well, I think I might end it there because I think I just sense that we've capped out every last square inch of the brain on everyone's as far as what everyone can absorb. But that was outstanding. That's really good information. As far as how to contact you from here, what's your website and how can people get a hold of you?
Website, we are Entrust Group is the name of our company. Entrust is spelled Entrust. And our website is theentrustgroup.com. So THENTRUSTGROUP.com. My phone number is 636-577-5100. Again, that's 636-577-5100. And my email is phagen@theentrustgroup.com with Hagen spelled Hagen. So PHAGEN@theentrustgroup.com. And if there's anything I can do to be a resource or any questions that you have, again, that's the part of my job. I enjoy doing stuff like this, but I enjoy talking to people about what they want or what to do with their retirement fund. So check us out. The website's got a ton of information. Like I said, we really have geared everything towards educating people. So there's case studies, there's webinars, there's graphs, there's all kinds of different things you're looking for, and it's all at theentrustgroup.com.
Great. All right. Well, thank you very much. And anyone that has any questions, feel free to ask in the comments section below. If you didn't catch how to contact them, just leave a message in the comments section below, and I'll be sure to get that information for you. And this has been an exciting episode I was looking forward to educating a lot of people. Thank you for coming on. That wraps up episode 4 of the Bob Wall Show. Thank you so much for joining us, and goodbye for now.